Hi everybody, this is Alan Ellman, the Blue Collar Investor, with today's option selling question of the day. Today's question comes from Jordan. Alan, I am soaking in all the information on your impressive website. One area I am not clear on is the difference between stock options, which you appear to favor, and index options, which I would think can be used for broader diversification. Can you explain the difference between the two? Thank you, Jordan. Well, first of all, Jordan, let me say that you are correct, that I do favor stock options, or known as equity options, where we use stocks and exchange-traded funds as the underlyings. Now, for those people that want to get a broader diversification, there are exchange-traded funds that are based on broader indexes, which can be used, like the select sector spiders, for example. And I have information on that in my books and DVD programs. But let's now focus on index options versus equity options. There are several very, very important differences, and there's a couple of things that are similar. So let's review them now, and I think then we can all have a good understanding as to what they are and what their differences are. Let's start off by talking about the underlyings themselves. Now, with equity options, the ones that I use, and of course most of the members of the blue collar investor community use as well, have underlyings as either individual stocks or exchange traded funds. Now, most of you know that exchange traded funds, or ETFs, are like a mutual fund in that they are baskets of stock, but they trade like stocks, so they can be bought and sold during the course of the day, and many of them do have options associated with them. So we can certainly use ETFs as the underlyings as well. Now, in the case of index options, we don't use individual stocks, but rather various indices that can be used to then sell options. So some example of stock indices that we could use with index options include the Dow 30, the ticker there is DJX, is the ticker for the index. NASDAQ 100, NDX. Russell 2000, RUT. And the S&P 500, SPX. So that represents the underlyings for the different types of options. Next, let's take a look at settlement, how these options are settled if exercised. So index options are only cash settled. There is no transfer of any stock. So if a strike price ends up in the money at expiration and we take no action, then there will be a transfer of cash either into or out of our brokerage account, depending on which side of the trade we took. Now, in the case of stock options, the transfer is not cash, but rather the underlying stock or exchange traded fund. So if we bought a stock and sold an option on that stock, and that option ended up in the money, and we take no action to buy it back prior to expiration, then if it was a call option that we sold, our shares will be sold at the strike price on the Saturday after expiration, Friday. Now let's look at the style of the options here between index and equity options. And there are two styles. We have American style, which can be exercised at any time through expiration. And then we have European style, which can be exercised only on the expiration date. So index options are predominantly European style, meaning that they can be exercised only on the expiration date. Some exceptions, though, which are American style index options. So here's a couple of exceptions. OEX, which is based on the S&P 100. XAU, which is based on the gold silver index. And SOX, which is based on the semiconductor index. Very, very hot at the time that I'm making this video. Now, stock options are American style. So that means that they could be exercised at any time from when the option was sold or bought through expiration Friday, 4 p.m. Eastern Time on the third Friday of the month in the case of monthly options. So if we wrote a covered call on a stock and we wanted to know when that option can be exercised because maybe we're concerned about our shares being sold, the answer is generally it'll be sold only after expiration, but there are some exceptions where early exercise does take place, and that's normally associated with an ex-dividend date. And again, we have all that information for you in our books and DVD programs as well. So let's go to the next difference, which is related to the options and the underlyings associated with those options. And index options are trade-only options. Okay, so we do associate those options with an underlying, but no underlyings are traded. So options are bought and sold, and when they're closed, options are, then there is a transfer of cash if the option expires in the money. Stock options, where both stocks and options trade. As you know, with covered call writing, you buy the stock and then sell the option. So both trade with stock options, but not so with index options, where only the options themselves trade. So when can these options be closed? I mean, if you bought or sold an index option, when can that be closed? Well, in this instance, index options and equity options are the same because they could be closed at any time. Okay, so now this is different than exercise, but they could be closed at any time. Now, of course, that assumes that the assignment hadn't taken place, because if assignment takes place, that's the end of the option. All right, you can't have assignment and then take some action on the option, because at that point in time, the option is null and void. Okay, so when does contract trading end? Is it different for index and equity options? And the answer is absolutely. There's a big difference between the two in this regard. Index options trading ends on the Thursday before the third Friday of the month. Okay, so a day earlier than equity options, which close at 4 p.m. Eastern Time on the third Friday of the month, if we're dealing with monthly options. So that is a very big difference between the two types of options, and if you're trading index options, absolutely you need to be aware of that fact. What about dividends? Well, if you're trading index options, sorry, there are no dividends. You're only trading options, and you're not entitled to receive any dividends, no matter which side of the trade you're on. However, with equity options, you are eligible to receive any applicable dividends. So if you write a covered call and we own the stock through the ex-dividend date, we will receive that dividend. Of course, the option premium will be affected on the ex-dividend date by the amount of the dividend, but that's something that's incorporated into the trade and something we have to know about upfront before we enter the trade. Now, what is the settlement price? So if a strike ends up in the money, what is that in the money strike based on? What price? And here is another big difference between index and equity options. In the case of an index option, we told you that trading ends on the Thursday prior to the third Friday of the contract month. Well, based on the opening price on that Friday, that will determine the settlement price. So trading ends on Thursday, and then the price that that particular index opens on Friday will be the settlement price. Now, in the case of equity options, it's the price of the underlying stock or ETF at 4 p.m. Eastern Time on expiration Friday, the third Friday of the month. Now, the price at 4 p.m. may take a couple of more minutes after 4 p.m. before that price is actually determined because of last minute trading and such, but technically it's the price of the underlying at 4 p.m. Eastern Time. So that's a big difference between index and equity options. Now, what is the type of settlement? This is really just terminology that we should understand. Index options, because they are based on the opening settlement price opening on Friday, that means they are called AM settlement. And equity options, which are dictated by the closing price 4 p.m. Eastern Time on the third Friday of the month, that's known as PM settlement. So that's a more or less a terminology issue. Now, how are in-the-money strikes settled for each type of option? And we've actually gone through it, but let's state it again to be thorough. Index options, there is a cash settlement. So if a strike ends up in the money, cash will either flow into or out of our brokerage accounts, depending on which side of the trade we took. In the case of equity options, if the strike ends up in the money, then shares will be either sold from our account or purchased into our account. So if we sold a covered call and it was in the money and we took no action, then our shares would be sold at the strike price. If we sold cash secured put and the strike ended up in the money and we took no action, then we will then purchase those shares at the strike price, and those shares will be put into our account. So shares will flow in and the cash to purchase them will flow out. Now, because of the interest that we've had in the difference between index and equity options, I have created a comparison chart, and that chart is placed in a file on the member site. So for premium members, log into the member site, look on the right side of the member page, the resources download section, and scroll down to I, where you see that arrow in the screenshot, and you could either review or download and print out that comparison chart. Now, as you know, as premium members, you're entitled to all of these Ask Alan videos that we've been making now for several years. This is actually the 150th. Many of them are based on trades that I've made in my own account, or trades that members have made and shared with us, and we have created these videos on some of the more interesting trades. And those can be located on the member site on the left side. You can see highlighted in the screenshot in front of you now. And all 150 Ask Alan videos will be located there, and we'll be adding one additional Ask Alan video each month. So that library of Ask Alan videos will continue to grow just as they have been for over the last several years. Now, we also have a video membership, so members that receive only the videos, including the Blue Hour webinars and the Ask Alan videos. And those Ask Alan videos are located under the membership content link of the video site. And you could see it on the screenshot now, and the arrow shows you that the subsequent videos are located below the ones that we're able to show on this particular slide. So there you have it. Jordan, thank you so much for asking that question. It's a question that we get fairly frequently, and I have included it in the past in some articles I've written, but I thought it was important to create this video since more and more people seem to be interested in it. So I appreciate the opportunity to share this information in this Ask Alan video format. And of course, I want to thank everybody out there who took the time to watch this video. Hope you enjoyed it, and most importantly, I hope you benefit financially for all the information the BCI team provides to our member and the public community. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.